Hi, everyone. Good afternoon. We'll just give a minute for people to come in.
Kendall, we need to learn how to take our hand and give each other high five.
I know it. I'm working on that one. I really am. And, it's going to be interesting. And, everyone will have a chance to see this. It's hard for me to walk and chew gum at the same time. So navigating Prezi and talking will be pretty interesting. So we'll see how it goes.
Good.
I'm going to keep my water bottle here and open and hope I don't spill it.
Well, I'll go ahead and get started. So good afternoon, everyone. This is Andres, Program Coordinator for NAMBA. I would like to thank you for joining today. Also welcome you to today's session on how pre-qualification soft inquiries are shaping the purchase market. So today, I would like to give a special thanks to our gold sponsors and partners at Factual Data for their support and for hosting the session. I would also like to give a friendly reminder that we are going to Orlando, Florida in September for a national conference. We really hope to see you there. Just wanted to let you know that registration is now open on namba.org and that we are looking forward to seeing you there. I would also like to remind everyone about our Connect tour. And if you are in the area for any of the remaining locations, please note that registration is complimentary on our website. Now, without further ado, I would like to welcome today's speakers, Kendall Lanier and Shelly Werner. Kendall has been a senior account executive at Factual Data for over 7 years. He has over 20 years in the mortgage industry, and nearly half of them he was top producing loan originator, averaging over $2.5 million in funded loans per month. And then Shelly is also a senior account executive at Factual Data with over 30 years of experience in the mortgage industry, with the most recent 12 years at Factual Data. She is very active in her local and state MBA chapters and currently sits on the board of Indiana Mortgage Bankers Association. In a prior life, she was an HUD certified credit counselor, I'm sorry. And then once again, I would just like to welcome everyone to our session. And without further ado, I'll hand things over to you, Kendall.
Great, thanks, Andres. First, I'd like to thank you and NAMBA for your partnership and giving us an opportunity to have an impact on the industry in such a meaningful way. Now, today's webinar is designed to be interactive. So as Shelly and I guide you through the pre-qual conversation, just remember to put any questions in the chat. You don't have to wait until the end of the presentation. As they come up, place them in the chat section, and Shelly, Melissa, and I will review them before we wrap things up. I'll turn it over to Shelly to share anything that she'd like to add.
Yeah, Melissa will be checking the chat, so that's good to know, and she's our marketing specialist. And we will have a few questions here and there. So one of the first questions that we had was, have you ever heard of pre-qualification soft pulls? And just put a yes or a no in the chat, or a question mark if you have no clue what we're talking about.
Good point, Shelly. So yes, if you have heard of pre-qualification soft pull, N if you haven't heard of it, or a question mark if you have no idea what pre-qualification soft pull is. And so before we hop into the presentation, I'd like to take a moment to talk about today's market. Rates have ticked up, margins have thinned and are thinning, and inventory has decreased. Now, in a normal business cycle, builders could increase production to help compensate for the decrease in inventory. But in 2022, today's environment, not so much. The increase in lumber costs and materials have affected builders' profitability and growth, of course. And as a result, they struggle to keep their margins as demand has outpaced supply. Now, buyer competition has increased with a recent study by the National Association of Realtors citing that there are, on average, 5 offers for every home sold in February. I'll pause for a minute and repeat that. On average, there are 5 offers for every home sold in February, which is up from 4.1 offers per home sold a year ago. Now, as a result of that, there's an increased importance on finding, qualifying, and retaining borrowers in today's market. And pre-qualification can help with each of those, identifying, qualifying, and most importantly, retaining borrowers. And that's what we'll discuss today, how pre-qualification soft pull has impacted the mortgage market in today's environment. And so I'm going to take a moment, Sally, and turn to the questions on the chat. Who all has heard of pre-qualification soft pull?
Well, we've had one person say they haven't, and they've always done a hard pull, and then others on here have said yes, they have heard of it.
Okay, and so that's where we'll begin. So we'll talk through an introduction. We'll talk a little bit about the why pre-qualification soft pull. And for those that haven't heard of pre-qualification, we'll talk a little bit about what is soft pull or pre-qualification soft pull. We'll talk through some of the differences between pre-qualification soft inquiry reports and other permissible purposes. Now, throughout the call, you'll hear me talk about pre-qualification soft pull or pre-qual soft pull or just plain old soft inquiry or soft pull reports. For all intents and purposes, whether I refer to it as soft inquiry, pre-qual soft pull, regardless of what it is for this discussion, that soft pull will be related to for pre-qualification purposes. And after we wrap everything up, we will answer any questions that we have there in the chat. And so we'll begin with an introduction to factual data. For our partners in the industry, I would like to think that we're aware of factual data, but if not, we are the premier data provider in the industry. We have a direct integration with the nationwide consumer reporting agencies, NCRAs. We like to think of them as Equifax, TransUnion, and Experian. We have a direct integration with Fannie and Freddie, and we manage everything from credit reporting to data verification services. And Shelley, could you take some time to share with everyone just a corporate overview or just our CBC family of companies?
Sure. Yes, of course, Kendall and I work in the factual data division, but our family of companies, our umbrella is CBC companies. And under that umbrella, we have factual data. We have Anovis, which is Anovis is the premier supplementary provider. We also have Data Verify, which probably some of you lenders on the call have heard of, Drive Reports, and that's the Data Verify. We also have Data Verify Flood Services. And then one that's not even on here, Kendall, is Byte. We own the Byte LOS software. So a lot of times Kendall and I both say, hey, we can take you all the way from the beginning to the end of the loan, QC, everything, and pre-qualification at the beginning. So we've got it all.
Absolutely. And I say jokingly, but from the cradle to the grave, from pre-qualification to that mortgage origination to closing and post-closing.
That's right.
We do it all. and so, Shelley, I have to say, we were talking before about, it's hard for me to walk and chew gum sometimes. And so as I manage through the technology, I may jump into some screens or backtrack if I need to, but just know I'm blaming it on Zoom and technology. It's nothing that I'm doing. First, we'll talk through some of the benefits of just a pre-qualification solution suite. Can you share a little bit about how lenders or credit unions are using pre-qualification soft inquiry.
Sure. Well, the pre-qualification is a soft pull inquiry before you take an application. So recently, I just signed up a credit union that is using it for home buyer seminars. So we can talk a little bit about that later, but I tell you what, it makes sense. You know, how many times we've been at a home buyer seminar first time and people are scared to have their credit pulled? Well, why not be able to offer a soft pull credit report at the beginning just to see their options of buying, their options of purchasing at that point? So that's really the biggest benefit to the consumer is going to be part of that experience.
Mm-hmm. That's absolutely right, Shelley. And so you mentioned about benefits to consumer. How are lenders using that in the market today?
Well, they're improving the experience by being able to offer the different options. You know, we could either come in and the customer can say, or the member could say, hey, I'm ready to purchase. Here's all of my documents. Here's everything. Take a full application. Or they can come in and say, I don't know where to begin. I have no clue. So it helps the borrower's experience on being able to offer a pre-qual soft pull at the beginning or jump into the application. It just gives the lender an option. It could also improve your approval rates, because if there truly is not someone that's ready and you don't have to pull a hard pull, which could ding their credit, but you could work with them on that soft pull. So that's part of the lender experience, I think, Kendall.
Yeah, absolutely. And so, I'm glad you brought that up. I'm going to talk about the elephant in the room, trigger leads. That's one of the things that I particularly like about the soft inquiry pre-qual soft pull reports. They don't impact a consumer's credit score. Right. And whether it's Experian, TransUnion, Equifax, it flies under the radar, so to speak. And it offers what I like to call a no trigger event. And we'll talk more about trigger leads and their impact on the borrower experience here in a moment. But more importantly, that pre-qualification soft pull gives lenders and those in the industry a head start at relationship building. We had talked about how you had mentioned some of your credit unions are using that as a tool during your first-time home buyers or home buyer seminars. And there's no better way to build a relationship with business partners, whether that's realtors, builders, or those in the industry, than to help them build relationships with borrowers or consumers.
That's right.
And so we'll talk about the market conditions. And we had mentioned how lenders are facing, I won't call it a dilemma, they're at a crossroads. Like, how do you manage credit expense, continue that focus on lead generation and driving those increased margins, and still retain those borrowers? And so that's where we're at from a market standpoint. Consumers are investing a good, or lenders are investing a good amount in lead generation and borrower retention. Shelley, have you had any experience with it at all?
Well, you and I both get phone calls how many times a week? I mean, it used to be like, I think you mentioned, maybe once a quarter, twice a quarter. I'm getting phone calls daily about market conditions and people calling other people's leads. So how that's called a trigger lead, right, Kendall? And so yeah. So tell us about what you had just said last week. Somebody called you.
Yeah, I used to, and I say used to. So we think back to 2015, 2016, 2017. I may have got one call, every 6 months because of trigger leads. But because of the state of the market, of course, we know that rates have increased, the refinances have all but dried up. And so now there's a continued focus on, where are we going to get that next borrower from? Now, if I had a nickel for every phone call or email that I received from my customers asking if factual data or if they sell their information, I'd have about 90 cents. So I wouldn't be a rich man, but those calls have gone from once every 6 months to 2 or 3 a week because of triggered leads and how much they've grown in the industry.
Well, I'm curious,
And
has
so-
anybody in here had a trigger lead used against them? Has anybody done that? So put it in the chat if you have, or if maybe you don't even know what it means.
Yep.
Yeah.
So good question, Sally. So those of you, if you have experience with trigger leads or maybe lost a borrower because of trigger leads, hit Y in the comments. If you know what trigger leads are, but don't have any experience with them, enter a no in the comments. And if you're unfamiliar with trigger leads and what exactly they are, you put a question mark, and we'll talk through that in a moment.
Yeah.
And so while we wait for everyone in the audience to kind of answer and give their response on trigger leads, Sally, could you talk us through what exactly is a trigger lead and how does that apply?
Yeah. Well, a trigger lead is it's based off of the inquiry of the application that's been taken. So if I'm taking a mortgage application and you are my borrower, all of a sudden that inquiry, if another bank has purchased a trigger lead from one of the 3 bureaus, and it says Kendall Lanier is shopping for a mortgage. So that other bank then gets your name, they might get your phone number, and they may even get an email address sold to them by the bureaus and probably some other data points too. But that is how that lead is sold, is because you've applied with me and I pulled a tri-merge credit report, and then an inquiry permissible purpose of a mortgage got sold to the next person. So those are called trigger leads.
Wow, and we'll talk more about the details of trigger leads here in a moment. So essentially, Shelly, if I'm hearing you right, consumer applies for a pre-approval or applies for a loan. From that point, that information about that type of permissible purpose or inquiry is sold by Experian, TransUnion, and Equifax to various lenders or those lenders out there that know that you're now shopping for a loan.
Right.
That is something else, and we'll talk more about the details on that. And it's one of those things that I won't say becoming rampant, but there is an increase on trigger lead activity within the industry. And again, soft pull is one of the ways that lenders are able to mitigate that.
Right.
Now, although we're seeing an increase of trigger leads here as of late, they're not new to the industry. And so they've been around for quite some time, and they a thorn in the side of the industry is the best way that I can explain it. So much so that there was legislation introduced into the House of Representatives in January of 2020 to amend the FCRA, or Fair Credit Reporting Act, to prohibit the creation of and sale of trigger leads, whether that's for mortgage purposes, and we'll talk a little more about this in a moment, but for other purposes as well, because we're finding that collection agencies or collection companies are purchasing trigger leads also. Mm-hmm. Now, we all know just in the industry, due to recent events, that was right around the time that COVID was taking shape, and people were, as a country, we were reacting to that, and as a result, the resolution was stalled, and it was never enacted. And so, before we hop into what can consumers do, what questions or what is the results or responses that we received in the chat?
About the trigger leads, Melissa, do you see any?
About the trigger leads?
We have not received any yet, But feel
Oh,
free to include those, anyone who has any questions about trigger leads, or if
okay.
you had them occur to you
I'm a,
or anything of that nature, feel free to add that to the chat.
yep. I'm assuming that everybody knows what it is. So, well, we'll hop into what trigger leads are. How can consumers avoid those trigger leads, Shelley?
That's right. Well, you can go out to optoutprescreen.com and you can take yourself off the list so the bureaus cannot sell your information. This website is maintained by the bureaus, and so it is an opt-out. Just think, if I am a credit union, a bank, a lender, and I've got a customer coming to me that's not sure about their credit, not sure if they could even afford a home. Imagine pulling a pre-qualification soft pull first, looking at that customer's FICO. The FICO is the same as the tri-merge, looking at that customer's credit, and then telling them, go out to optoutprescreen.com. Get yourself off the list before you pull the tri-merge credit report so that trigger lead isn't sold. So wouldn't that be an awesome step to do? But I have done this myself. I know Kendall and I've talked about it, and he's done taken his name off too. But for you guys on the phone that like to have competition, you might not want to take your name off the list, but you can take your name off permanently or for 5 years. And it takes up to 5 days to get your name off. That's all it is, up to 5 days. So that's it.
And I took a look at the opt-out website, and it's happening, or it's being removed in as little as 3 days. And you had mentioned giving those, so 3 to 5 days is what you can expect.
Right.
But one of the things that you mentioned, Shelley, really stood out to me is you're giving, it gives lenders a chance to give their borrowers guidance. So that to me speaks to the ability to build that relationship,
Yes.
so that when those trigger leads happen, and it may or may not happen, it may, you may go through the closing process, they're able to purchase that home, and nothing ever happens. But in the event that it does, then you're building that relationship by giving them or giving that borrower guidance on next steps and what they can expect along the way.
That's right. And, Kendall, one thing I didn't mention is I usually tell my lenders, tell your clients up front, tell your members up front, they might get a phone call from somebody on those trigger leads. And it's just education. So.
Mm-hmm. Yep, absolutely. And so I agree with you 120%.
Yeah.
So we talked about the why pre-qualification soft pull, and we want to talk about shift gears and talk about what exactly is a mortgage pre-qualification. Could you share some information on that, Shelley, or talk us through what exactly is a mortgage pre-qual?
Yeah, it's basically the early step in the home buying process. When the consumers pre-qualify for a home loan, they are just receiving an estimate of what they can borrow. So basically, it is a soft pull with the same FICO. You can do a 1, 2, or a 3 bureau soft pull, depending on what your company would like to do. But it truly is an easy first step before you take the application and before you spend the money on a tri-merge report. It's a less expensive credit report is what it is, and it can save money. For the lenders on the phone, it can save you money. And how about time?
Absolutely. And I know what everyone's thinking. That there are realtors and some of my referral partners that isn't going to put anyone in their car to show them houses with a pre-qualification versus a pre-approval. And I can say that as an industry, we've become savvy about the mortgage pre-qual versus the pre-approval, but also we've become savvy about the guidelines and taking a glance at things and how if we're able to get DU approval or not. Consumers have got just as savvy, we had spoken earlier about how one of the credit unions were using that as a tool in their home buying seminars. Could you share a little bit about that, Shelley?
Sure. And I also had a bank do the same thing. They just recently hired a CRA officer, Community Reinvestment Act officer. And so they were planning on seminars around different parts of town, and they were going to be able to offer being able to pull a pre-qualification report right after the seminar. And I think this kind of begs to thinking maybe you're not qualified for a home. But if you saw your credit report, credit score, and talked to a lender right then and there after hearing the information, I bring this back to my daughter who talked about buying a home over 2 or 3 years ago. But she knew, because I'm in the credit industry, you don't let people pull your credit a million times, right? So she was scared to go to anybody to say, what can I do? How much do I need to save? But if somebody had said to her, it's not going to hurt your score. It's a FICO that's not going to hurt your score. It's a soft pull. I think my daughter would have said, well, get me on the right path right then and there. And I think that's what this bank and this credit union is seeing the value of that, being able to say that. So it would help.
Yep. And Shelley, I just had a light bulb moment. For you had mentioned the first time home buyer seminars, but for those originators or lenders that have relationship with realtors that have open houses, what a better way to begin that relationship or capture that lead by being able to tell those visitors that you're able to give them an idea of the home that they're able to afford without an impact to their credit score and without placing an inquiry on their score, so on their credit report. So it gives them an idea of the home that they're able to afford. You're able to give that borrower guidance on what they're able to afford, and build that relationship at a time that the flip side of that, borrower walks into an open house, takes a look at the home. Hey, you have nice faucets. See you later. And that's a lead that's potentially lost, because just me as a consumer, I am not going to let you pull my credit report or put a hard pull on my report if I'm just kicking the tires. And that's one of the benefits of pre-qualification soft pull, and that's how it's impacting the mortgage industry, is that it captures that segment of the population that may or may not be savvy about inquiries, but they do have a need to understand how much house can we afford, or if it's something that's even feasible. So it improves the borrower experience.
It definitely does.
That, in your case about your daughter, she spent 2 years looking for homes because she didn't want to hard inquire on the credit report.
Nope.
I'm in that same situation. I'm not a fan of hard pulls. If there's a way to, number one, I have to give the disclaimer. I'm very aware about what credit is and what's going on with it.
I think probably everybody in this phone call probably is the same way. We're all working in this industry.
Absolutely. You're absolutely right. And so borrower experience is one of the things that leads to borrower retention. And that's one of the benefits of pre-qualification soft pull. The other thing, again, the elephant in the room, are trigger leads. It flies under the radar, so to speak. And we'll talk about permissible purpose and how pre-qual soft pull differs in that way. But because it's a different permissible purpose, it avoids trigger leads, meaning there isn't a hard inquiry placed on that borrower's credit report. Lenders are able to get an idea of what their credit profile is like. Or even if it's, if they have a 200 FICO, then, we may want to give that borrower guidance to on things that they can do to improve or increase their credit score in order to keep them on the path of assistance.
Did you say 200?
I said 200. I know the range is only 350, but I wanted to, and finally, it helps lenders manage credit expense and lead investment. And so I'll spend a little time on this one, and then we'll hop into the differences between pre-qual and pre-approval, and some of the ways pre-qual shines in that regard. Now, I recently had an experience with one of my customers, and they were asking about pre-qual soft pull and how that can benefit their process. Now, as a way to do the research or gather information on, we took a look at 6 months, the previous 6 months of credit pulls or credit inquiries, credit reports. And we asked if, what happens if we, instead of pulling a tri-merge on every single one of those reports, what happens if we pull a pre-qual? And so I'm gonna pause here and turn to the audience and ask if what the industry average is for pull through. Meaning, credit reports that are pulled versus how many loans or how many loans that close.
Actually close,
So
yeah. It's interesting because
will,
when I talk to my customers, everybody thinks it's a lot higher than what it is. And it'll be interesting to see what everybody's thinking, because a lot of people think that they close a lot more than they do, because we see the billings and the closings, customers show us that information.
I had someone tell me that their pull through is 80%, meaning 80% of the credit reports they pulled credit on went through the closing. And so it's either that one or it's the idea that pull through are the loans that are submitted to processing versus how many actually close. And so for what we're doing today, the metric that we'll be talking about is how many credit reports did you pull? How many loans did you close?
Right.
And so we'll see if there's any responses in the chat.
Yeah, we've had one guess.
Yeah, we have one right now at 25% is a guess that we have.
Okay, 25% close or 25%. I imagine, so 25% of loans that close. That's what I would imagine. That's close, actually.
Yeah.
And we'll give everybody one more chance.
Don't be shy.
Don't be shy, guys. Come on.
There is no wrong answer.
That's right.
Yeah, it kind of is.
All right. Got 35%. Yep. 33%.
33%.
Thanks, everyone.
That is close. Yeah, absolutely. And we'll split the difference. It's actually about 70%, meaning 30% of the credit reports. We have a couple more responses. 30% of the credit reports that are pulled actually close. And that's one of the things that we took a look at. Now, theirs was a little over 70% fallout, meaning if I'm zoning loan officer, I take 10 credit applications, 7 of those applications aren't going anywhere. Now, the other 3, are going to move on to closing. And those are the loans that we're able to recapture that expense on. But the other 7 loans or the other 70%, there was no way to recoup that. And again, that's one of the differences between pre-qualification soft inquiry reports and your standard tri-merge is that you're not able to pass those charges on to the consumer. And that was the lender that I'm speaking about. That was their challenge, is that, Kendall, we know that we can't pass this cost on to the borrower. We know that it is a cost that we are going to have to absorb. But knowing that there is typically a difference in price between pre-qualification reports, which are typically, I like to call it a stripped down version of the tri-merge. The credit score is the same. Of course, the content is the same. The difference is you're not going to have a bunch of the data points like trended data that you find on your tri-merges. And so I took a look at 6 months of activity, just knowing that my fallout is 70%. Would it have been cost effective to pull a pre-qual report on every single one of these reports and only pull a tri-merge on the other 30% that are moving forward? And, after review, it turns out they were saving over 7% on their credit expense, which doesn't sound like a lot. So I'll put it into perspective. And I'm certainly going to ask you to do some math too. So $7,000 a month is what it amounted to, a little over $7,000 a month. What would an extra $7,000 a month be, I guess, for on an annual basis? It works out to be an additional salary. That's 7 times 12. And so that's the impact that pre-qualification soft pull reports is having on the industry.
It does. Yeah, that is. So the savings there can equal to another person in the back office, another loan officer. Yeah. Maybe another new LOS.
Yeah, I know it. So I've talked a lot, Shelley, and so we're going to let you talk about permissible purpose, of which we spoke about throughout our conversation. Well, intention, just the process, and the differences between a pre-qualification report and a pre-approval.
Yeah, the permissible purpose is the key to it, because the permissible purpose of a pre-qualification report is the written instructions of the consumer. So to be able to pull that pre-qualification report, you do have to have a signature that they agree to it, or a verbal agreement with it written down. They have to have certain language for that. And so it's to inform your client of their potential buying power. So it's great for anybody that walks in, says, I'm not sure about my credit. That's the permissible purpose. Now, what a permissible purpose is, and I know you were going to ask me that, Kendall, I see it in your eyes. What's permissible purpose? That's the inquiry type that we get from the bureaus that goes out and can get that trigger lead, right? We talked about trigger leads. So the permissible purpose of a pre-approval is different. And that's what triggers those leads that we hear about. So the permissible purpose it's a hard inquiry, and it's the pre-approval. It would be a true credit application. So the pre-qualification report only needs name, address, social. You as a loan officer might want to get some additional information, such as, do they have enough money for down payment? Things like that. But the permissible purpose of a pre-approval is a full application.
Yep, you're right. You read my mind, Shelley. I was going to ask about permissible purpose.
I knew you were going to. So when credit, when I go and buy, let's say I go buy a boat, that's a consumer permissible purpose. I buy a home, that's a mortgage permissible. That's what those are. The bureaus use those.
So as you were saying that, I just had a light bulb moment. So the permissible purpose code, so I am your average consumer. I apply for a pre-approval. That permissible purpose code is sent to the bureaus. And of course, because under FCRA guidelines, it has to be included along with consent, or someone documenting that consent. And so that's how companies are able to determine, what is a mortgage application, or what qualifies for a trigger lead event, or what is a borrower out car shopping.
Right. That's exactly right. That's exactly right. Yes. And so the pre-approval is really not a type of report, but it's a hard pull. It's the mortgage inquiry part of it.
I see. And that's what, in giving those consumers or those borrowers those pre-approvals, you run DU, you document, of course, the pre-approval. It just gives everyone the confidence that we're able to extend credit to this person. So I would imagine a pre-approval is a little more involved.
Yeah, it is. It's more of a full application. You have to document it, send letters if they don't, denial letters, things like that. So there is a lot more to it. There is.
Yeah. And so just as far from a process standpoint, so you pull the credit report, consumer provides documentation for what we'll call it 2-2-in-1. 2 years W-2s, 2 years bank statements, pay stubs, things of that nature. And of course, the lender informs them of the credit of their decision within X amount of days.
Right.
So question, if to the group, if I am walking into an open house, or if I am, a first-time home buyer, would you be comfortable sharing that information with someone you met 30 minutes ago? Please say yes, a Y, or a no in the chat. And we won't pause for that one. So I'll ask you, Shelley, is that something that you'd be comfortable with?
I think if they told me they could give me options on what I could have, and that wouldn't hurt me, and the score wouldn't hurt me, the inquiry wouldn't hurt me, then I probably would be very interested to see what options I would have to be able to buy a home. If I'm in open house, that's why I'm there, right? To look. I'm kicking the
Yep,
tires,
and
as you
so-
said.
Yep. And so just to be clear, so if you're walking into an open home, an open house, or home buyer seminar, or if you're walking into a builder's location, you'd be more likely to pre-qualify for a home, provided that it's not going to affect your credit score, it's not going to place an inquiry, and you won't get 200 phone calls after you do it.
Right.
And you heard it here first, folks. We're average consumers, so we're going with the pre-qual. So, Shelley, we talked a lot about pre-qual soft pull and the differences between pre-qual soft pull and a pre-approval, but we haven't talked a lot about pre-qual soft pull and the differences between soft pull, refresh reports,
Right.
undisclosed debt monitoring, or different other types of those soft inquiries. So what is the difference between those?
Yeah, I even had a client ask me this. They said, well, we pull a soft pull before closing. They're checking to make sure there's no additional debt before they close. And can't we just use that same soft pull that we use at the end? And again, it's permissible purpose. So that permissible purpose is only for them for the closing. The soft pull before closing, that's a permissible purpose. Those don't get sold on the market either. This is a permissible purpose for you to see what you could qualify for at the beginning of the process. So there are different soft pulls throughout the mortgage process. This is just a newer one. This one's been around for a while, but it's becoming more and more. People are asking about it. Yeah.
Absolutely. So what I get from that is a pre-qualification is always a soft inquiry, but not all soft inquiries are pre-qualification.
Correct.
So for those people out there that saying, well, hey, can I use a pre-qualification report to check to see if my borrower has any additional debt? Shelley, what would your answer be to that question?
No. It's a wrong permissible purpose. We can set you up with a soft pull to do that. Yeah.
Absolutely. Pre-qualification reports have a different permissible purpose than other credit inquiries.
Right.
And so things you want to consider. Pre-qualification report is not a credit application. Now, that's an important distinction, and because it's one of the things that separates the pre-qualification report and a pre-approval. It cannot be used to extend or deny an offer of credit to a consumer. Pre-qualification reports, for all my lenders on the line, they cannot be reissued, meaning that you can run DU or LP through an automated underwriting system. And we spoke about this in the example that I shared earlier, is that lenders shouldn't directly or indirectly charge the consumer for a pre-qualification report.
Right.
And so we've talked about, how pre-qual soft pull reports save time, how they help manage the credit expense, and how lenders are using pre-qual soft pull reports to increase borrower retention, say that 5 times fast, and borrower satisfaction. And so knowing that, I'll turn it over to you, Shelley, because I'm prone to forgetting things, especially with as busy as I have been lately. What else would we like to cover? Or am I forgetting something? Because otherwise, we're at the Q&A portion of it.
Yeah, no, we're at the Q&A portion. I don't know if anybody's got any questions, but something popped that I remembered. I have a friend that lives in Florida, and Florida is, booming right now, right? You can't even buy a home. It's so bad. So she went to the website to look up just housing. What about when's the next subdivision coming up? And so she applied online just with this builder. He would not even see her without pulling a pre-qualification soft pull to see if she even qualified to move into a subdivision. So there's lots of reasons people are pulling these pre-quals out there. I mean, that's how crazy Florida was. So it was very interesting when she told me that. Yep.
And I'm thinking that's a story that's happening across the country, Shelley. It's a really good point. And from a builder standpoint, for those people that are just kicking the tires, so to speak, you're able to, I say, sort through those and determine which people are credit qualified or where you should focus your efforts.
Right.
And so it's a really good point. And so I will pause here, and I'll ask that Melissa ask for if there's any questions in the chat. I don't see any new questions, but I would like to think there's at least one question floating out there in the cyberspace.
You are correct. We don't have any questions right
have?
now, but if there are any questions anyone has, please share those in the chat right now, and Kendall and Shelley can help you out.
Yeah.
So no questions. And one thing that I forgot, and again, I'm blaming this on Zoom and the technology thing. If you're a lender or in that lending space, what are some things that I need to consider when approaching pre-qualification soft pull? If I'm, looking at adding that to my process, the number one question is that I get from lenders are one of the things that you want to consider is how do you plan on offering pre-qualification soft inquiry reports or those soft pull reports, either in person, over the phone, in a mobile device or point of sale, or on the website. Each one of those, it has a separate and distinct way that you have to capture consent from, or that written consent of the consumer that we spoke of, and document. And so that's the number one thing that lenders want to consider if they're looking at that, looking at including that in their portfolio or their offerings. And so I will pause here and see if there's any questions, and I'm going to put our contact information on the screen.
Yeah, that'd be great. There's Kendall's information on the screen. There's my information on the screen. Reach out to either one of us by phone or email, and we'll be glad to answer any questions. If you're shy about asking questions on the webinar, I understand. I'm that way sometimes myself. So yeah, reach out to us and we'll answer any questions. And you know what? You don't actually have to be a factual data customer to be able to use our pre-qualifications.
Absolutely.
So yeah.
Questions don't cost a thing. And so for those lenders that do have questions out there, please reach out to us. It takes a moment of my time to answer that. And Shelley, she types fast, so she'll reply much faster than me. And of course, you can always give us a call or email us at information@factualdata.com. And with that, I will turn it over to Andres and the NAMBA team. And again, thank you for your partnership.
Yes, thank you.
Well, I just wanted to say thank you everyone for joining, and thanks again to you, Kendall and Shelley. This was great. Thank you for sharing in such an important topic in the industry. I can say I learned a lot just by listening.
Good.
And this was great. I really we are really thankful for our partnership and to have you guys host this session. To everyone else, please be on the lookout for the recording of today's session on your email. And without further ado, have a nice day, everyone.
Thank you.
Thank you, everyone.
Thanks so much, everyone.
Have a great afternoon.
You have a great day. Goodbye.
Bye-bye.
Goodbye.